Good evening and welcome to the FITT Show. Financial information for today and tomorrow. I'm Bobby Kinzer,
And I am Thomas Doty.
and we are the FITT Show, helping our people get their finances in shape. Welcome to everybody around the world, out there in virtual world. Thank you for tuning in for another evening of information about finance and portfolio management and budgeting, saving. We trying to provide tips and understanding so that people can make better and make good decisions about their finances. Last week we talked about avoiding money mistakes. This week we want to talk about investment principles for all times. There's a lot going on out there with the market and it's just the world in general. But just want to remind everybody, can you please continue to share your Facebook page with other people? And if you're on YouTube, that you please subscribe to YouTube and also share the YouTube site so people can subscribe because that's how we expand our audience. Our audience is from teenagers all the way up to 70-year-olds. So we're thankful for to have such a broad audience. And we try to reach as many people where they are. We try. But like always, we say, use the comment box and put some comments in there of shows that you or topics you like for us to discuss. That always helps. And plus, putting things in the comment box also gives us traction. That's how Facebook works. You reach more people by having comments and click on the like button and the heart button as many times you can because that also increases our audience or access to the audience. Note, how's everything going with you, my brother?
Life is good. It's good to be
Yeah.
on this side.
Yeah, thank God. It's good to be seen and not viewed. That's for sure. So dope. Let's start with our top of the show topic that everybody is always interested in. Let's talk about the stock market.
Yeah, one of these days we're going to have good news, but it's funny too because everyone was anticipating a 0.75 basis point increase in the for the Fed to increase it by that much, and that's what happened. But the market still reacted negatively, and I think that's because there was some hawkish talk in his presentation, which kind of made people a little more nervous. And he was talking about recession and how difficult it is to try to have a soft landing. So we're going to be in this thing for a while. So it's just hang in, tighten your seatbelt, and try to hang on. But for the last week, the market, the Dow went down almost 500 points or 4%. Nasdaq, which got beat up pretty bad last week, also went down almost 2% or I'm sorry, or uh, probably missing the Dow. But anyway, that's Nasdaq that went down
Oh,
500
sorry.
points.
Yeah, yeah. Oh, sure did. They
Oh, no
cut it.
problem. Yeah, but Microsoft's down about 4 points. The whole tech industry is taking a beating right now. Tesla's down 15 points, and Apple's actually up a point. Again, I think that's the strength of their new products. And finally, I believe Pfizer was up a point. Oh no, Pfizer's also down a point. So
Right.
it's been ugly, and it's going to continue to be ugly for a little while until the Fed feels inflation is under control, and then I think we'll see things start to get a little better. But it might get worse before it gets better, and that's the reaction in the marketplace right now.
Yeah, it's been so volatile, and the crypto market has just been, man, it's been tanking over almost over 70%. But we said, it's highly speculative. It's doing what it said, but a lot of reasons why it's going down because the dollar is strengthening. And one of the reasons for the creation of cryptocurrency globally was to, go against the fiat currency, which is, the currency of a particular country. But the cryptocurrency market, the market cap last week was $1 trillion. It's down to 982 billion. The Bitcoin last week was at $19,713. Hasn't gone down that much. This week is down to $19,411. Now, it had gone as low as 18,000 early in the week per Bitcoin, but today it's up 4.7%, and it's still the number one cryptocurrency out of the over 18,000 cryptocurrencies. The market cap is at 371 billion. That's a good sign. Shiba Inu is interesting. It keeps fluctuating, going up and going up, and down more so than Bitcoin, but it's up 4.3%. And it dropped though. Last week it was at the number 12 cryptocurrency spot. This week is at 13. Interesting enough, the Dogecoin, which is backed by Elon Musk, it stayed at 5 cent, a Bitcoin, but it actually increased in this market cap by over over 100 billion. And no, yes, that right? No, over 100 million, excuse me. And it went from number 11 up to number 10. So cryptocurrency, though, is always volatile and speculative, like we said. So you must be, cautious with investing in it. But we always say it's for the long play. And as always, we're looking for it to come back. So I want to get into our topic today, Dope. Investment principles for all times.
Yeah, and it's really a good time to talk about this because when times are good, nobody's worried. There's no caution out there. You just happy-go-lucky. And when the economic environment is good, everybody's happy. Over this last 11 years, this bull market, which ended in March, stocks rose steadily. Companies were getting easy money. Many professions were paying big money. Life was good. Many investors took consistent positive returns, and you could make a bad decision, and it wouldn't be a bad decision because everything in the market was going well. But to quote Warren Buffett, he has a saying: "You only find out who is swimming naked when the tide goes down," and that's that's kind of appropriate now because things are kind of tough. Over the past couple of months, the tide went down, fiercely as the market plunged at a historic pace. The S&P dropped about 34%, trillions of dollars in shareholder wealth vanished. And this experience has been a wake-up call that the good times don't last forever. And that's what you got to remember during these times. That this has happened before, it's going to happen again. The market doesn't just go up forever. And so you got to stray too far. You don't want to stray too far from a prudent, smart investment plan. And that's what we're going to talk about today.
Yeah, a lot of times when these troubled times occur, Dope, that is very tempting for people to have financial missteps, and especially in bad times, make bad decisions, hasty decisions, what they call FOMO, fear of missing out. And then you got people with financial scarcity who are afraid to do anything. But now is a wonderful opportunity to revisit any investment principles that you may have. And as many investors, they're searching for guidance. A lot of people are searching for guidance from investors, financial advisors for guidance during these challenging times. And so that's what some of the things we want to discuss with you today. We got a few good ones, and like we said, this is not just for bad times, good times. These are investment principles that are timeless that you can use. So, Doug, why don't you start off with the first one?
Yeah, the first one, and the foundation of any prudent financial plan, is to have an emergency fund, and that could be from 3 to 6 months of cash, waiting for something bad to happen. And as everybody debates how bad this current bear market's going to be and the total effect of the coronavirus pandemic, people with ample cash, they're in a good position to be able to handle this. If they lose their job, they can make do. If their income drops significantly, they can make do. And cash reserves allows them that flexibility to sail through these challenging times relatively unscathed. And if you're concerned about your future income, you're well advised to continue building your emergency fund with extra cash. you can't have too much extra, because times as they are now can turn bad faster than you can expect it to happen. And you don't know how long, we don't know how long this is going to last. It can take some time to rebound.
Now, I know we probably sound like a redundant parrot, but debt is bad. And we got to emphasize, because debt really stresses people out. It really is an albatross around people's necks. And many advisors will point out that, there's both positives and negatives, with borrowing, but in the right set of circumstances, leverage may be quite helpful. Now, a lot of people, best safe financially are general those folks who are not indebted to anybody. They are usually the people with better position, because that debt, becomes such a, I mean, you wonder about where you're going to, get the money to pay it off. And it can really be very stressful, especially if you go out there and purchase non-appreciating assets and just be purchasing liabilities. But, even the most sophisticated investors and institutions can run into trouble if you don't really monitor your debt. Now, in the next few months, there's going to be so many stories of companies that are going to be, bellying up, that are going to succumb to the insurmountable level of indebtedness. Even with the student loan debt forgiveness, there's going to be still a lot of people strapped with a lot of student loan debt. But we cannot emphasize it enough. Eliminating debt is one of the most powerful financial positions one can find themselves in.
Yeah, but one thing to remember is not all debt is bad. Okay, some debt can help your financial health, and a lot of people divide debt into good debt and bad debt. And you think of good debt, it's used to finance goals that will increase your net worth. Bob talked about acquiring appreciating assets. So good debt can help you, things that will grow in value, such as earning a college degree or buying a home or investing in a small business. It's even better if it carries a low interest rate and it's tax deductible. That actually reinforces that it's good debt. Bad debt is money borrowed to buy things that won't last or things that you can't afford, like an expensive handbag or something that you charge to your credit card and you don't pay off in time, or you take a trip, that you finance with a home equity loan. Those aren't considered good debt because, one, they don't appreciate in value. They don't add to your net worth, and you'll be stuck paying some crazy interest rates. And sometimes the boundaries between good and bad debt can be a little gray. And a lot of people would consider a loan for a car to be a bad debt. But I mean, if you need a car to get to work, or you need a car to pay a repair, it's a necessary debt. So good debt, bad debt doesn't really fall into play there. But still, too much debt of any kind is overwhelming. And even good debt can turn bad when you have too much. So even you can't say, well, I'll go out and buy 20 houses. You got to be able to afford what you're doing. And if you think about the 2008 financial crisis, those are people who invested in housing and ended up losing a lot of money. But rather than forgetting about that altogether, the key is understanding its purpose, doing what you can afford, and using it to help you increase your wealth. So if you consider taking out a loan, make sure you understand the details. You need to know when you got to start making payments, interest rate, and any other terms that are in that contract. Make sure those payment terms fit into your budget. In other words, make sure it's something that you can afford.
Yeah, and the reason why a lot of people get in debt because we buy a lot of stuff that we don't even need, or we be buying stuff to impress other people that have no kind of economic value, So, really, really be conscious about your debt, you all. Though I want to talk a little bit about a clear understanding about your time horizon. Now, a lot of these topics we get from Kiplinger, report on the net, and we like to encourage you to go out there, look. It's free. They got some great financial advisors and give some great information, and so we pull a lot of information. As a disclaimer, we pull a lot of information from them. So check that out, you all. And just want to talk about a clear time horizon, because what people don't realize, a lot of people don't realize, that really dictates the amount of risk that you should be actually taking, because they say, a man, without vision, will perish. And that's what happens with even a lot of the young people today. I feel the young men, mainly, they don't have enough vision to set goals. But your time horizon, you need to really, really consider it. And it's also, in these rough market conditions, it's very important. It keeps you in perspective. And if you're a long-term investor, then the bear market shouldn't even affect you. Shouldn't even concern you one bit, because you're in it, because you have a plan for the long term. It offers you the wonderful opportunity to buy equities and buy them at a meaningful discount compared to when they're trading in other months. They might be higher. Now, if you're a short-term investor who plan properly, you also should be, you should not be scared of the current bear market, because your portfolio should have been sitting in cash or allocated in quality bonds and such that it shouldn't bother you, because you had the right asset mix for the impact of the conditions, so that because your investments are not plummeting in value, because you structured them according to what your time horizons is. So it is irresponsible to invest without having a clear understanding of when you need to use your money.
Okay, next we're going to talk about dollar cost averaging. And that's simply the process of routinely adding money to investments at regular intervals. Every human being is emotionally charged. And some people get emotional about politics, others about industries or companies or businesses. So emotional decisions have no place in the world of successful investing. And so the benefit of setting up automatic routine contributions, it eliminates the emotions from your process. It eliminates the desire to try to time the market, and increases your ability to build wealth over time. And as it is now, if you think about it, during good times, you're buying less shares. During bad times, you're buying more shares. That's the benefit of dollar cost averaging. And you don't have to worry about it. You simply just invest and pretty much let it ride.
Another area of investment principles is rebalancing. Now, we know about asset allocation and diversification, but rebalancing allows you to make money without even much effort. Because the act of rebalance is when you adjust your weighted portfolio as investments go up and down to maintain the original asset allocation based on the risk tolerance. And that's why you need to rebalance. So for instance, if you had a 401k plan and you had a lot of stocks in the growth, and you had some in the G fund, which is money markets, government securities, and all of a sudden you had a drop in your growth stocks, and it changed, and you wanted to keep your growth investment at 30%, and now it's increased to even larger. You might want to go in and rebalance it, because it changed. The market goes up and down, and it affects your asset mix. So while simultaneously adding to the positions as they go down, that's what rebalancing does. Rebalancing allows you to sell in the positions when they go up, and simultaneously add to the positions when they go down. Because the old adage is sell high, buy low. This is the way to do
it. And the other part of that allocation is diversification. And that's the only free lunch you get in investing. And there's a tendency for investors to find and pile into the hot investment and put a lot of money in that. And that's great when things are going well. But everything, every companies, sectors, industries, regions of the world, they all go through cycles. When things go south, having too much money concentrated in any one area of the market can be devastating. And you can look through history and find this. Think about technology stocks in the 90s, financial stocks during the Great Recession. Those things, they were going great, then all of a sudden, they went bad very quickly. So if you had too much money in them, you suffered. So the best way to protect your portfolio from the risk of overconcentration is to have a policy of diversifying across many asset classes. While such a strategy may lead to some investment laggards, you're going to have some losers. Everything's not going to go up, but it'll also ensure that you should have relatively high-performing investments within your portfolio as well. And that's typically how things work. Some things go up while some things go down. And this slow and steady approach is a sensible way to ride out future market bubbles. You don't want to have too much money invested in any one market, any one segment, any one region. You want to spread it out, and so you can grow steady but sure.
Now, according to the Kiplinger advisors, they say conservative bonds have a place in everyone's portfolio, and I truly believe that. Because when the market is soaring, many investors won't even look at high quality fixed income, because it usually doesn't pay out the interest as high as equities. But after all, why invest in anything other than high flying technology stocks? Because the reality is that bonds serve as a crucial purpose in all investors' portfolio. They provide psychological benefit of minimizing the volatility during turbulent markets such as now, with inflation, taking off, just like the I bond. We talked about the I bond. I bond is a great inflation buster. As inflation keeps going up, the I bonds responds to it. Right now, the I bonds for the next 6 months, not the next 6 months, the 6 months ending in November, is at 9.63%, and then it recalibrates the next 6 months. And if the inflation is higher, then they probably go higher than the 9.63. So lastly, rebalancing opportunities with stocks fall in price and that the highest rated bonds appreciate. To dismiss bonds is a core element of one's investment strategy, and you should definitely consider looking at quality bonds, especially like treasuries and that are backed by the full faith and credit of the United States government.
Okay, the next is high returns means a high level of risk. All investors want this magic bullet of high returns with no risk. It doesn't exist. When times are good, some folks may think they found it as their investments continue to rise. However, when conditions turn, they realize that expected high returns could mean a higher level of risk. And that nature of risk could come in many forms. It could be leverage, it could be illiquidity, could be poor credit. But the bottom line is, if you want to achieve high returns, you need to be willing to take a high level of risk. And it's important for investors to go into every opportunity with their eyes wide open. Again, if you want a high return, you have to be willing to accept that high level of risk. If you don't want the risk, then you have to settle for a lower return.
And that's good advice, though. No question. You gotta keep your eyes wide open. The next one, though, is boring over exciting could be the right approach. Now, what does that mean? Now, investors often are confused with the next get-rich scheme, the next exciting idea with a good investment opportunity. But the excitement could lead you into the latest fad or an exclusive deal or strategy that promise to bounce the performance of the S&P 500. These opportunities are more often than not being sold on hype and not on their fundamentals. Now, if you want to avoid this type of lure, then pursue an approach of sticking with plain vanilla, as they call it, boring investments. Now, this may be a combination of blue chip stocks, index funds, or high grade bonds or treasuries that we talked about. Now, investors may miss the next hot initial public offering, but they may also won't get sucked into a Ponzi scheme. the trade-offs are worth it. Dope. I had a guy call me yesterday, a good friend of mine. And it was a company called, I won't mention the company, but they were doing cryptocurrency and Forex on a platform, and they were making it like a multi-level marketing. And he was asking, what do you think about it? So I went to see if it was a cryptocurrency, and it wasn't. I went to see if it was a stock, and it wasn't. I went to see was it at least registered on FINRA, which if you ever want to know about, it's a company registered or not, the financial industry, FINRA, FINRA.org. You can go out there and look and see which mutual funds are rated. You can look and see which broker dealers are out there, and if they really broker dealers, and you can find out about, if these companies are regulated. And this company wasn't, though. And I went and looked further. They were a Ponzi scheme. There was a wife and a husband, and they were actually taking people's money in, and the address wasn't into a real place. They filed bankruptcy 3 and 4 times, and they also had gotten dissolved by the state of Texas. So you got to watch out for these, things that seem exciting for you to get into.
Yeah, and the next one is a problem that I hope all of you have. Once you win the game, stop playing. What does that mean? The stock market can be an addicting place, especially if you've accumulated a substantial level of wealth. It's important to understand the main purpose of investing is to be able to achieve your goals. Once you reach that magic number, there's no reason to continue to put money at risk. Granted, if you're looking to build multi-generational goals and that going to last decades in the future, then obviously you should invest accordingly. However, the money that's already been accumulated to fund an investor's lifestyle could possibly be moved out of equity. Investors who have reached that point are in the enviable situation of no longer needing to stress over the next bear market. And so you get to the point where you can take much less returns and have a very very low level of risk. And with that comes a very low level of stress and worry, and just sit back and enjoy.
And I think a lot of people don't, they spend so much time, trying to do the right thing, stressing on if they made the right decisions, and then they don't know when the time is to just sit back and enjoy the fruits of your labor. I know a lot of people that are still working, and I understand a lot of people have to do that. But, man, it's about enjoying life, and money isn't everything. It's sure better than not having it. But
Bob, but the important thing here is to have a goal. And again, things change, situations change, economic conditions change. But have a goal and work towards that goal. And once you hit that goal, you don't have to be in the race anymore. You don't have to be in the battle. You don't have to deal with the stress. But we always emphasize the importance of having goals. And once you reach your goal, then you can kick back. That's okay. You won the game. You can stop playing.
Yeah, and that is such good information, Dope, because this is all about investment principles. And you gotta have a basics, a foundation, so you don't get caught up into the next best, scheme, or the next best investment, or you go to your family picnics, or you go to the weddings and people start trying to tell you these get rich quick schemes. No, stay with the plan that you have. And also, we always talk about this, though, and I want to remind people, seek advice, but from qualified people. We prefer that you seek advice from, a registered investment advisor. But, there's other people, that have good knowledge. And, if people, ask them how they doing, how they perform. That's how you find out. If they're making money and they have portfolios, then yeah. So that's why this show, we try to share as much information with you in hopes that you would do the same. So with that, though, let's go to the summaries of our show today. We talked about a lot of things there, though. So let's wrap it up. So one of the first things we talked about, bad debt. Debt is bad. And there's no other way that we can put it. You don't want to burden yourself with, you know, paying debt that's lasting 2, 3, 5, 6. I know people that got credit card debt that's been, on their credit card, never paid off in 10 years. Debt can literally kill you. So please work on getting that debt down.
Yeah, and portfolio management is crucial. We talked about a couple things there. We talked about rebalancing once one segment or one of your assets has grown to keep your allocation at your appropriate level. And we also talked about diversification. That's the other part of making sure your investments are spread across multiple assets. So as one goes up or as one goes down, you also have something that may be going up that's not in the same cycle, not in the same market, not in the same region.
Understand your time horizon. We can't emphasize that enough. Most reason why a lot of people fail is because they fail to plan, and it's so important that you have a target, and you all can always adjust it, because life is about changes. But the key is, if you shoot for the moon and miss, you still fall upon the stars. That's the theory.
Yeah. Boring and steady is not always bad, especially when it comes to investment. We always talk about, Bob talked about understanding your time horizon. Time is always on your side. And so if you can consistently invest, use dollar cost averaging, spread your assets, that's the best way, the surest way to build wealth.
And the final one is know your end game. Now that's different than understanding your time horizon, because time horizons deal with short term and long term. But the end game is really, really understanding, what you're trying to reach and have you reached it. Because what I'm finding out through a lot of my friends is they're getting there, in their retirement, and they planned and they did very well. And then they realize it's not a bunch of things they want or need. So now they got all this money, and the next thing is now they thinking about leaving it, to their loved ones, to their kids, provide generational wealth. So it's so interesting. You spend all your life trying to reach these goals, and when you reach them, and you think you're going to be wanting all these stuff, but like at 70, 75, what thing? How much more stuff can you really, really want? So know your end game, so that when you're there, I mean, you might been thinking, oh man, I don't even know if I'm going to have enough to live on, and you'll find out you have more than you have to live on. The next thing you're going to be thinking about, maybe I should leave some to a charitable foundation. I mean, that's a good thing to have. So,
Hey Bob, one
you
of the things we always talk about is having experiences as opposed to things. You spend most of your young life thinking you want things, but like I said, you get to the point where you've got all this money and you all you did is work, or all you did was save, and you never really enjoyed it. So find that happy medium of enjoying experiences and not just accumulating things.
stuff. No, I looked at my neighbor's garage, right? He has a 2-car garage. He has 2 Mercedes, right? And they're $80,000 a piece. He opened up the garage on the right, and I've been here, hey, wow, I've been here 22 years. And it's been the same thing on the right side of his garage. The door opens up, and it's packed all the way to the ceiling with stuff. So he parks his $80,000 Mercedes in the driveway, the $80,000 car, but he's got all this stuff in his garage. And I've been seeing the same stuff. I don't know, maybe he's changing inside the garage, but it's filled to the tops. And I'm like, wow, that's interesting. I mean, and it's his choice, but it's kind of ironic that you sit in your $80,000 car out in the rain and the snow, you got all this stuff you're not even using, and it's in your garage. So anyway,
I hope he ain't watching the show because he's gonna hate you. Yeah.
I ain't say his name.
You said your neighbor with two $80,000 Mercedes.
Oh, I know. I live in PG County, dude. Okay, the highest per capita. There ain't a black person in my county without a Mercedes, except me. But anyway, you know who you are. You're right, though. You know, forgive me. So anyway, y'all, thank you. Make sure you'll tune in next week. We're so thankful for y'all being here. We really appreciate it. Though I want to give a shout out to Carl Chapman, who's always there for us, man. Maddie Ford. Maddie said, man, I am so thankful for the great information that you two give. And Garnett, thank you. Garnett said, thank goodness for you too. And my sister Gloria even said, thank you for this information. So, thank you all for tuning in as usual. Next week, we're going to have another topic. And remember, give us some ideas of things you want to talk with. We want to talk about. We're going to start inviting guests, that's going to give more information too. So stay tuned. Thank you for tuning in to the FITT Show. Financial information for today and tomorrow. We're here every Thursday at 8 p.m. See you next week. Same bat channel, same bat place. Have a wonderful rest of the week.